All right, stocks follow through with the selling from Friday. It was a little bit more selling today. It wasn't as bad, a very small range. The volume stayed relatively steady, but this range really dropped down. Kind of sets up for what might be a morning star candlestick pattern for potentially tomorrow or the next day. So I'm going to break that down, what that means, what that looks like, how important it is that we bounce up tomorrow if we're going to maintain the expectations that the correction is over and we're going to get to new highs by the end of the year. Because that Friday kind of broke a lot of things that if we follow through on it can really confirm that break. So today wasn't a whole lot of follow through. There was some, but the narrative that has been so bearish for us all year long was there today again. And so I'm going to show you that as well. What the different sectors are doing, which ones are already leading to the downside, and which ones are still showing relative strength, and why that's the case. And then we're also going to break down some important moves in bonds and the dollar, and then our trade idea as a stock in the healthcare area that's kind of breaking down, but still some very, very strong support. So we'll talk about how to trade something like that. A bearish stock that has a lot of bearish expectation. So let's go ahead and get started. Today is Monday, August the 29th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel. Use that subscribe button down there. Also hit that thumbs up icon to like our video tonight. Also comment what stood out to you from the video today. Join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. Also, if you're watching us here on our blog, check out these things over here on the right, our Market Outlook Live and our upcoming classes. You can also come down here, click that heart. It opens up this tab. Hit that like button. Same thing here with the thumbs up icon. Click on that. Opens up this tab. Hit that like button there. Again, the more you do that, the more it helps get our content out to all of our followers on those platforms. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the S&P, the S&P fell today a little bit, down 0.2%. Continued the decline from Friday, but not to a large degree, below average on the range. The intermediate line did continue lower, still barely in bullish territory, but maybe for another day. That looks like it's going to head down below 60. In fact, I would say probably unless we like materially change higher by the end of the week, and potentially as soon as tomorrow, we're more than likely going to get that intermediate line crossing below market sentiment, which is a bearish crossovers typically can be bearish and lead to more bearishness. But if it can hold here at the bottom of this bullish territory, maybe getting a little bit below 60, but still above 50, hold that market sentiment in the rally. And again, it's not going to do it tomorrow, right? Because this is a lagging, it changes, it's got a time frame. Now, the short-term sentiment, which dropped below the 5th percentile, the momentum line came back up right at the very, very end, like literally right at the very end. I think SPY might still be, it came up to just barely there at the end of the session. They were both below the 5th percentile. The near-term line got even lower this time than it did on the last time it got below the 5th percentile. So both really extreme lows. But you notice we are not below that 2.5% mark, below the moving average yet. So, and we really kind of slowed down the pace than what we had. So we'll see if we can be able to hold this 38% retracement level, this green one, which is of this decline that we had broken up above here on this nice little rally starting at the end of July, going into August, peaking right before expiration, coming down into and out of expiration, and then now sitting right back on that 38% Fibonacci retracement level. Last time we broke this level, we kind of broke them pretty hard. So we'll see, but probably we're not going to break down. If we break down, we're probably not going to break down nearly as hard. Within 2 sessions, we were down from this level where we're at currently down to 3750. We lost 150 points in 2 sessions. If we get back to 3750, it's going to take a lot longer than 2 sessions, my opinion on that to occur. But I think the likelihood of us getting back to 3750 is relatively higher now, and would be a lot higher if we were to break this 4,000 level, this 40, which would also mean that we're breaking the 38% retracement, which would also mean that we're breaking below this 2.5% mark below the moving average, and it would start to turn. See, when you got the light green shading and the green line, light pink shading and the yellow line, excuse me, to turn it red, to not just bounce right back up, to turn it red, you've got to get down more than just 2.5%. Otherwise, even just barely getting below it still isn't enough, right? It eventually turns back up into new legs higher. So it's got to roll back over, right? We are now, on a bullish trend here, but light pink shading yellow line instead of the other way around when you have bearish trend. You can see over here we got light pink shading and yellow line, and we were okay until right pretty much this day right there that broke us down significantly. So it's the same thing, right? You get us another day to break down below 2.5% significantly and below this 38% significantly. Now we got all these lines that were so significant to break back above, they'll be acting as a support. Like I said, 38.50 plus or minus a few points down into that area. So that's what the S&P, they all look almost exactly the same. The NASDAQ is actually a lot closer to breaking below its market sentiment line and is more than 2.5% below its market, below its 30-day moving average. And you can see the Russell 2000 is not, it's barely below, but it did finish with both lines below the 5th percentile, and it's a little bit higher on the intermediate line. So not as bearish as the Qs have been. So let's take a look now at some of these other charts. Let's take a look at the weekly crossover. So pretty bearish candle back below. We got the red arrow last week. We're easily below that now. It's a bearish close. It's a pretty bearish, pretty obvious rollover there with the PPO that was rising starting to decline, right? We had a couple of weeks in a row where it stayed at 2.32 and now it's at 2.39. So slowly starting to decline with a pretty significantly bearish candle. It's a pretty decent size of a bearish candle that you don't get when you're bullish, right? You can see we did once here and immediately turned back up. So when we're bullish, we typically don't get down below these levels. When we're bearish, we do get the more significant bearish candles to the downside. And you can see the washout candle that we talked about in June, mid-June there. So, and we talked about the possibility, the likelihood that even though that's the washout of the correction, that we're still going to get the low point of the correction probably forthcoming, and it appears to be that's the case right now. Let's take a look at some of these other oscillators. The DMI, the negative indicator jumped up above 25, is now above 30, but the positive indicator has barely dropped below 25. So it's got to get below 20 for us to get that ADX to start to turn back higher again. So it's a pretty negative indicator, which again, to get this negative, even with a high, so last time it did that was right here, where you had a really negative DMI, a negative directional index, but the positive was still pretty positive, right? It still wasn't breaking below, it's barely breaking below 25, and it was actually kind of crisscrossing it, didn't come close to breaking below 20, but then eventually did, right? So it's a very similar pattern now that we had there, that again, it looks like we have the potential just bouncing right off of this light pink shading yellow line. If we do, great. If we don't, then you can see we're most likely getting a new leg lower here, and that's, I think the odds of that kind of pattern happening are more and more likely, especially with the CCI getting down to a lower level that you typically don't get to in bullish trends, below this minus 150 level. The RSI is still holding up in bullish territory, the low point of bullish territory, the 40th percentile, but it's still holding up. So it's like, this is all the makings of some kind of like morning star candlestick pattern where you have a pretty deep bullish candle, a doji pattern, and then a pretty significant bullish candle tomorrow that would get at least to the halfway mark. Sometimes you might get a doji or two, like the textbook definition is only one doji. I've seen cases where you've gotten two, maybe three, like you kind of get a prolonged period of neutrality here. But then the idea is whether it's tomorrow or Tuesday that we get a really significant bullish candle. Considering how bearish short-term sentiment is in the market forecast, if we were to get that, then you can see how just really bullish that would be. That would be really, really bullish, essentially starting a new leg higher for the markets. My expectation of that happen is not very high. You can see the bullish trend that we had is gone, so we don't have any trend right now. We're still below the blue line. We got below the blue line. We're still below the blue line. When you look at the 3 red arrows, now it's 2 days of 3 red arrows. Remember, anything more than 2 or 3, and now we're stuck, right? You get 1 or 2, and those are really good buying signals. But if you get a 3rd or a 4th, now we're stuck in a bearish move. It's not just like this. It's not just, we're not just a pullback anymore. Now it's more, right? I mean, now it is a pullback. It's not just a near-term decline. Now it is a pullback, right? You can expect the intermediate line eventually to get below into bearish territory, right? So that's why you see there, if you look at the 3 green arrows, I mean, again, we're below the 17-day moving average and have been now for 1, 2, 3, 4, 5, 6, 5 out of 6 days. The 1 day was that surprise pop before the Jackson Hole event. But then now we're back. So the MACD is now negative. So it's below its moving average. It's falling. It's negative. And we're easily below 17-day and not going to cross above it anytime soon. And we're below the value area for the 1-year chart. So, and heading into some very low volume levels, areas of the market in the past year compared to where all the volume has been in the past year, which has actually been above us. Interestingly enough, as bearish as we've been, right? We've been pretty bearish here. As bearish as we've been for the past year, most of the volume for the past year has traded above us, not below us. So again, that's why it's so hard to recover from corrections, and especially bear markets. Bear markets literally take years to recover from. And that's why I don't think this is a bear market, because if this is the low point and we bounce off of this, again, new highs by the end of the year or early next year, right? And then Tom Lee would be right. Like and people who subscribe to that, that way of thinking there, that everything's always bullish. Right? But if we can't bounce off of this and we stay down, and even if we just don't even get the significantly lower lows, but we just stay down here by, say, October expiration, then the odds of getting back to 4,800 by the end of the year would be very, very low, to the point of, now you're talking 12 months to recover from a correction, which is extremely long, and is not, now we're not talking about corrections, now we're talking about pretty much the beginning of a bear market, when you can't recover the correction within 6 months, 6 to 8 months. So again, you go out to the last real bear market we had here, and you can see by the time we had the new highs in October of 2007, by the time we got here to May, we were 7 months in, right? So we still probably have a good month or two we can get there to new highs, but we didn't. And by the time we came back down to those lows, it was a full year. It was 10 months. With the likelihood of getting new highs very minimal within a year. Again, that's not typical of corrections like everything else we've seen. It's very typical of, like I said, the beginnings of a bear market, where that bear market started right there in June, July of 2008, and then eventually ended in March of 2009 when it hit that low point there. So that's how, again, the likelihood of that happening are stronger as we are back below the 8 and 17 week moving averages, and the MACD itself is starting to turn down too, potentially getting back below its moving average, again on this weekly chart. Let's take a look at today's intraday move. Lower high, lower low, obviously. We tried to get up to yesterday's low, and we did. We couldn't get through it, right? So we filled in the gap, common gap, we filled it in. So we don't have to worry about going up anymore to fill that in. We did it. And now we are back down, right? So we are trading back. We closed easily below yesterday's low, Friday's low, and which was also last week's low. So pretty bearish candle from that perspective. The fact that we couldn't get back above that resistance, if we filled the gap, but we couldn't continue through the resistance, kind of shows again that the likelihood is more, that we're going to be more bearish. You can see the Arun indicator. It's still pretty high here. Like we're still, remember now that we got the bearish crossover, you can expect the green line eventually get to 0, and then as it does, once the red line gets below 70 and the green line gets below 0, that's when you can start looking for the bottom. And so we don't have that yet. The red line's So over here you can see they kind of got there about the same time. Over here it kind of got at the same time. The red line got below 70. The green line got below 0, and that was your low point that eventually broke out to new highs. So we need the green line to get below 0 and the red line eventually get below 70 before we can start looking for the low point to be formed here. When you look at the Hull moving average, you can see, I mean, that's a pretty significantly bearish candle there. I mean, it's a bigger candle than, again, that we've seen in a while, that when you go out long term, this on the daily Hakunashi candle, when you go out long term, you can see you don't get this size of a bearish candle. If you follow my cursor all the way to the left, you don't get this size of bearish candle in the bullish market. You only get it, as you can see here, during this correction. So it's a significantly bearish candle that we are still easily above the 200-day moving average, though. We are moving pretty quickly down towards it, down below the moving average right there, and it doesn't look like we're crossing above it anytime soon. So lots of bearishness. Last one I wanted to look at, because I've been showing you the McClellan oscillator. The fact that it couldn't get above 1,000 was very important, right? We were really watching for that level, because that's what you need to get to really solidify, so to be able to hold through any downturns. We can still stay bullish. Well, we didn't get there, and now we're almost back below positive 500. In fact, and again, barring a tremendous Morningstar candlestick pattern, we're more than likely going to get back below minus 500, which is not necessarily the best sign, right? When you're getting back below 500, as you start to really kind of form the high point and turn bearish here. So getting below 0 is obviously more significant, but getting below minus 500 pretty much nullifies the break above positive 500. So we're not as bullish anymore. Okay, one last chart I want to take a look at is the VIX. Big jump in the VIX. We are above the 95th percentile, so we are in bearish territory, though we're in weak bearish territory because we're still below 1. So keep that in mind, but still pretty significantly bullish move on VIX. We've been expecting this, right? Because of the seasonality. Number one, because of the seasonality. Number two, because of the correlation. The correlation is still not very strong. So there's still, you still expect that the VIX and the VVIX, the VVIX actually dropped today. So you still expect that, if we're on a if that correlation is going to get back to as strongly positive as it normally is, that they'll both go up, because that's been the pattern. And that seems to be the pattern so far right now. So if you take a look at SPY even, which is still a negative correlation, right? And it's not, if you look at here, you can see here, whoops, sorry. Let's go to a daily chart. You can see, it was a positive correlation, and that's not normal, right, for it to be so positive. It is negative, but it's not back down below the 3/4, the 0.75 yet. So there's still some room for the correlations to recover, which in the past, when they have recovered, means that both the VIX and the VVIX go up and SPY goes down. So what do you think of that? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Tell me what charts or indicators you're looking at that suggest why you're either a lot more bullish than I am, or you might be a lot more bearish than I am. Show us why down in the comment section down below. All right, well, let's take a look now at what's driving the price action today. And you can see we were pretty flat all day long until the end of the day. Right at the very end of the day, we kind of really fell off a cliff. Bonds were down all day long, and commodities were up all day long. So again, there's your story of inflation, right? Commodities and yields moving to the upside. The dollar also gaining ground against everything but gold, but it did outperform all the equity asset classes and as well as treasuries. As well as corporate bonds and treasuries. So you can say the dollar was up from that perspective. So you have your dollar, you got commodities, and you got yields. That's your inflation story. That's what's been so bearish for stocks all year long, and that continues to be the story that we see now. We've been looking at the rebound in commodities. Remember how the drop in commodities is supposed to bring inflation back down? Well, here we are back up, and now we're back out. Not only are we above the 50-day moving average, the 8 and 17-day moving averages are now 2. And now we're above the highest close since the fall since that low point, and then we are out of the value area. So now we're grinding because there's a lot of volume to get through. But if we get back above 28, back above that 23% line, then we are moving back up. And yields are above that level, right? So yields did get above 2.985, which was its 23% line of its pullback. And it is, again, the 8-day and 17-day are above the 30 and are now both crossing the 50. You can barely see it there. You can see they're both crossing the 50, and a renewed move to the upside. In fact, if you take a look today at mortgage rates jump back up to almost 6% today. So just like that, we were barely above 6% over here, but again, it took to go from 5.55 to 5.85 to 6.18. It took 2 days to make that move. So here, 5.55. We're taking about a week or so to get up, and we're still not to 6.18. So you can see how you go parabolic, but then after you rebound, you end up getting to the same spot just slower, and you're able to maintain potentially going through that spot. So the odds for rate hikes, and this is what you saw with the yields here, the odds for rate hikes have gone up. In fact, if you look at the odds for 150 basis points for the rest of the year. So here's 70% odds for 75 basis point hikes at the next meeting. Just a week ago, it was only 55. So it was a coin flip a week ago. Now it's relatively high probability. Then you look at the December contract, and a week ago we only had 30% odds of getting 150 basis points by the end of the year in 3 meetings. So that'd be 75, 50, 25. Now it's 60%, or it was close to 60 earlier today. It's 54% by the end of the day. So and a month ago it was 0. So we've gone from 0 to 60 in a month for that last hike. In fact, for that 125 to get to 375, it was 16 a month ago, and now it's what, 80, 91%. We've gone from 16 to 91%. And to get to 325, 350 a month ago, it was what, 50%? No, 66% to get to that 350. 66%. Now it's 93%. Now it's foregone conclusion. So, and that's 100 basis points. So we were kind of fluctuating at a coin flip, 50-50 here. In fact, it was kind of a low probability, but now it's foregone conclusion. So the odds have really increased, especially in the last week. We've really increased from a week ago to now the odds of tightening going on further beyond the year. And of course, February still remains that will stay at this 400 basis points, and there's some odds of going up further. So of going up more and getting to 425. Whereas before we were looking at odds of maybe coming back down starting in 2023. So in fact, going to June 2023, the odds of staying at 400 basis points, if that's where we end up getting to, it's still about an 80% odds that will still be at 400 by February, and we're not coming down, right? So those are still very, very high odds. We've basically have taken away, see over here, just a month ago, the odds that we had 80% odds of being at 325 and lower odds of getting higher. So we've gone from 80% odds of being at 325 to 80% odds of being at 400 for June, which means we've essentially gotten rid of the Fed pivot. Now keep in mind, the yield curve is still very inverted. It has been since beginning of July. It remains inverted. The yield curve remains inverted. The 10-year has been rising. The 3-month has been rising too. It's up to almost 3% now. So again, that's 50 basis points higher. So getting above 3% would fully price in from the bond market standpoint, that 75 basis point hike. And that's why we're getting the moves that we're getting. And you can see it on UUP as well. Right? We're not coming down from these highs. We're still hanging around these highs. And the longer we hang around those highs, the more likely we are to push through those highs, as we regain some momentum up to the upside. So the dollar remains strong, and a lot of it lately has been against the Japanese yen. you can see that it's all the U.S. dollar against the yen is almost back up to its 52-week highs. Against the euro, it's down. It's still right around parity. It can't extend itself below parity, but I mean it's at parity. It's at a really, really important level. And again, looking at the U.S. dollar yen, the U.S. dollar yen is the parity is 100. So if I were to go back out here 20 years, the last time the yen, the dollar was parity against yen, it was close in COVID. It got to about parity in 2016 and has been up ever since. It was actually on the other side of parity here for most of the decade before this last little rally and weakness in the yen. And of course now, again, going all the way back, we're not at the weakest, but we are pretty darn close to the weakest that the yen has ever been against the dollar. You have to go back to the long-term capital management era when things really hit the fan because of how strong the dollar was. That we were, so it's not necessarily the best thing for the U.S. economy per se, global economy to have such a strong dollar. Let's take a look at the sector moves that we're getting today. Right, just today alone. Remember, everything was kind of flat except for the inflation trade. The inflation trade kind of rearing its ugly head again. And you can see what that's done here. Energy stayed higher and utilities have stayed high. So those have been the big winners year to date. If you look at the year to date picture, those have been the big winners year to date, and they're still the big winners. Staples doing well too. So those are that's the story of the year, and that remains the story of the year, as those are the areas that did better today, at least held their gains better today, especially by the end, where XLK ended up at the low of close to its low of its day, and down more than 1.25%. If I look at the 12 grid for all the major sectors here, you'll see that we have light pink shading, yellow line across the board. We have dark pink shading and a red line on XLC and on healthcare. Those are where you're getting a lot of clusters, and the market for in the email that I send out that you can sign up for. We have that's where most of the clusters are, but everything else you can see it's light pink shading, yellow line. So if we're gonna be bullish here, we need to bounce up right now. If we didn't bounce up here, we came really close. It looked like we were gonna bounce up there, and we didn't. So if we're not gonna bounce up there, we gotta bounce up now. We cannot extend below the 30-day moving average and turn what is a really good bullish signal here into a bearish signal like these others, right? These are bearish signs when you're over here. You still have, energy and utilities are dark green shading and green lines. So again, that's where the strength of the market is, in those two areas right now, interestingly enough. In the past, utilities have actually gone up when yields have gone down because it's a kind of a safety, it's like a either or trade. Where do you get your yield from? Well, now yields are going up and utilities are going up. So it's an interest rate sensitive sector, but it's behaving in an inflationary way, because and when we are in an inflationary environment, stocks and bonds move in the same direction. And that's what they've been doing. If you take a look at the correlation here, let me go to a correlation study. If you look at the correlation to SPX, TLT, we've been relatively positive over the past for most of this past year or so. We've been above 0% for most of this time, and generally, when you're in a deflationary environment, that's not the case. If I were to go out and look at a kind of a weekly chart, a little bit longer term chart, you can see. Let's go out to a full year. So we'll just do 52 here. And look at the full year, and you can see for the most part that they are negatively correlated. This has been one of the more positively correlated environments that we've seen. And the last time was kind of mid 2014, is another period where the dollar really took off. But stocks and bonds, in that case, they both rallied. In this case, they're both falling with that really, really strong. I mean, what's the correlation? 85% correlation on a year, on a 50-week basis, 52-week basis. More like probably 50 weeks when you account for the holidays. But yeah, even there, 86%. It's a very strong correlation. In 2014, it got to 81%. So 82, a little bit more than 82. That's And this is one of the stronger correlations that you've seen in quite some time. If I were to go back, because it only goes back, yeah, to over here anyway. This is the strongest correlation. We might have been a little higher, 85, or 86. We were 86.3 right there. So we were just a little higher earlier a few weeks ago. So we're essentially at the highest that TLT and the S&P 500 have ever had since TLT has been in existence. All right, now let's take a look at our trade idea of the day. If you take a look at Merck, Merck is getting that, again, it's in the healthcare, so it is getting dark pink shading and red line. Healthcare, remember, and communication services, where now it's not getting a cluster, but it does have stronger bearish short-term sentiment that we've had in a while. Definitely has lost the bullish momentum that it had when you look at its trend strength. It did have some bullish momentum going forward here. Over here, but then we've lost it. We've been really sideways, and the clouds really flat, which means we've been flat, and we've been trading above it and below it, and with both lines inside of it. So I mean, that's about as neutral as you can be, and it's reflected down here. This is no trend strength whatsoever. If you look at the DMI and the ADX, the ADX is well below 20. I mean, we had a good strong trend, and it's petered out. Now you do have the beginnings of a bearish trend because we're above 25 and below 20, but we're not above 30. Getting above 30 is what really gets the ADX going to where it could possibly get above 20 and then above 25. So you got to get above 30 and you got to get below 20. Over here is getting well below 20 that really pushed it, got it going. So you are below 20 easily. You're just not quite above that 30 level yet. On there, and you look at like the RSI and the CCI, and you are definitely out of bullish territory, and you are slightly in the bearish, so slightly below 40, slightly below 150, but not quite. Again, when you are so sideways, you're looking for a breakout pattern here to get you out of these red dots. You need to get typically through with the green dots. You need to break below the Bollinger Band and the Keltner channel. So all these other times, you can see that we've broken through. We were actually trending right there, and we finally broke through with a breakup above those levels there, kind of above 100 right there on the Bollinger Band, and then eventually above the Keltner channel. So we haven't had that yet. We've been so sideways, we never pushed through the upper band or the lower band to start a bearish trend to the downside. Both times we came close, but never pushed through, and so still we're not pushing through. So we're not bullish, but I don't think we're necessarily bearish either. And then you can see here there's how bullish that we are. We're still above the value area of the 1-year chart, and not only is the whole entire value area still below us, which is a lot, 70% of this year's volume is still below us, but the point of control is down there too. So there's some really strong support to the downside as we move lower. You can see we are below the 17, the 8, 17, 30, 50, we're below all those, and they're all crossing each other to the downside, but we're still above the 200, and we've been kind of trading in between the 50 and the 200 for quite some time now. Without really, you kind of have to break through the 200 now to get out of this price action that we've been seeing here. So what I decided to do is, okay, well, since we're not bullish anymore, but we're not really bearish, I thought, well, let's do an iron condor spread, selling the 82.5, buying the 80, selling the 92.5, buying the 95. That gets us here to this trade, and you can see for a full position size, I'm getting about double my normal reward. And when I put those break evens on there, you can see I've got my good break evens. It doesn't guarantee, I mean, it's a relatively high probability of getting a reward, but what it does guarantee is for me to get to close out this trade and take a $686 loss, it needs to really break out one way or the other. It's got to break out, because I've got my break even down here at this change at the point of control, and I got the other break even pretty much at new 52-week highs. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Also remember, you can subscribe to our website at marketscholars.com and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.